Across China, a peculiar phenomenon continues to unfold. Vast, modern metropolises rise from the ground, complete with gleaming skyscrapers, intricate road networks, and meticulously planned parks. Yet, many of these cities remain eerily quiet, largely devoid of residents. This visual paradox, often referred to as ghost cities or empty cities, represents one of the most visible and perplexing outcomes of China's rapid economic growth over the past few decades. For an outside observer, the sheer scale of this vacant urban development begs a fundamental question. Why are these cities being built if no one lives in them? The scale of this urban emptiness is not anecdotal, it's systemic. Reports from entities like the China Household Finance Survey at Southwestern University of Finance and Economics have indicated a significant oversupply in the housing market. In 2017, for instance, it was estimated that over 65 million homes in China were vacant. To put that into perspective, this number exceeds the total housing stock of several European countries combined. These aren't just isolated districts. We are talking about entire new cities, designed for millions, that remain largely uninhabited years after their completion. Early Western media reports often characterize these ghost cities as clear evidence of a looming economic collapse or a monumental planning failure by the Chinese state. The narrative frequently presented images of desolate urban landscapes as proof of unsustainable growth, detached from genuine demand. However, as economists and urban planners began to delve deeper, the story revealed itself to be far more nuanced than simple overreach. The motivations behind these constructions are deeply embedded in China's unique economic structure, its political incentives, and its approach to national development. At the heart of the ghost city phenomenon lies a critical aspect of China's economic model: land finance. Local governments in China do not collect property taxes in the same way Western municipalities do. Instead, a primary source of their revenue comes from leasing land use rights to property developers. As researchers at the Peterson Institute for International Economics have highlighted, this system creates a powerful incentive for local officials to continually rezone agricultural land into urban land, sell these rights, and generate immediate income to fund public services and infrastructure projects. The promotion structure for local officials also plays a significant role. Career advancement often depends on meeting economic growth targets within their jurisdiction. Building new cities, attracting investment, and demonstrating rapid infrastructural development are tangible achievements that get noticed by higher authorities. This incentivizes a focus on gross domestic product, GDP, growth derived from construction and real estate, sometimes at the expense of genuine demand or long-term sustainability. The pressure to grow often outweighs the risk of creating empty spaces, especially when the immediate financial benefits are so substantial. For Chinese households, real estate has traditionally been seen as the safest and most reliable form of investment. With limited alternative investment channels and a historically strong appreciation in property values, buying homes, even multiple homes, became a popular way to store and grow wealth. This investor demand fuels speculative buying, where properties are purchased not to be lived in, but to be held as assets, anticipating future price increases. This phenomenon contributes directly to vacancy rates, as many of these investment properties remain empty. Let's put some numbers to the land finance model. According to official government data and analysis by institutions like Moody's, revenue from land sales constituted a staggering portion of local government budgets. In 2020, for example, land transfer fees accounted for over 40% of local government total budgetary revenue. For some local governments, this figure could be even higher. This dependency creates a powerful cyclical relationship. Local governments need land sales for revenue, which incentivizes more construction, which in turn leads to more land sales, creating a potential oversupply. This land-driven revenue model can distort the traditional relationship between demand and supply in the housing market. Instead of building based purely on organic population growth or genuine housing needs, construction becomes an engine for local government financing and GDP targets. Reports from analysts at Gavekal Dragonomics suggest that this structural incentive has consistently led to an overestimation of future demand. Developers, encouraged by local governments and the perceived safety of real estate investment, continue to build at a pace that outstrips actual occupancy. The boom in China's property market over the past 2 decades has been nothing short of extraordinary. Fueled by rapid urbanization, rising incomes, and the investment preference, property prices soared, turning real estate into a powerful engine for economic growth. Data from the National Bureau of Statistics showed consistent double-digit growth in property investment for many years. This growth, however, masked underlying vulnerabilities, particularly the speculative element and the reliance on ever-increasing prices to sustain the model. The question was not if, but when, this rapid appreciation would slow or reverse. To understand China's path, it's useful to compare it with other rapidly urbanizing economies. In countries like South Korea and Japan during their high-growth phases, urbanization was largely driven by industrialization, with housing supply closely following job creation and population migration to industrial centers. China's model, while also seeing massive migration, added the significant layer of local government land finance as a primary economic driver, creating a powerful impetus for infrastructure and housing construction even in areas with nascent industrial bases or uncertain future population influx. The reliance on land sales as a revenue stream has led to a dramatic increase in local government debt. When land sales slow or property prices fall, this revenue stream diminishes, leaving local governments struggling to service their debts, many of which were incurred to fund the very infrastructure projects designed to attract developers. According to reports from the International Monetary Fund, IMF, off-balance sheet debt, often through local government financing vehicles, LGFVs, has grown substantially, posing a significant risk to China's financial stability. State-owned enterprises, SOEs, play a crucial role in this dynamic. Many of China's largest property developers are SOEs, and they often lead the charge in developing new areas, sometimes with implicit backing from local governments. This symbiotic relationship ensures a steady demand for land from local authorities, as SOEs are often tasked with fulfilling development mandates. While this can enable large-scale, coordinated projects, it can also exacerbate the oversupply problem, as SOE developers might prioritize strategic directives over pure market demand, further contributing to the growth of empty cities. For private developers, the incentives are equally strong. Access to financing has traditionally been easier for real estate projects, and the expectation of rising property values promised significant returns. Developers borrowed heavily to acquire land and construct projects, often pre-selling units before completion to finance the next phase. This model, while efficient for rapid expansion, relies heavily on continuous sales and escalating prices. If demand falters or prices stagnate, developers quickly find themselves in precarious financial positions, as evidenced by recent events. A critical contributing factor to ghost cities is the consistent over-optimism in projections for future population growth and economic development in nascent urban areas. Local governments, keen to justify their land sales and infrastructure spending, often commission studies that forecast massive inflows of residents and businesses. However, these projections frequently fail to materialize, especially in less desirable, remote locations or those lacking robust job markets. The result is a substantial mismatch between the envisioned population and the actual number of people moving in. China's internal migration patterns are complex. While millions have moved from rural areas to major urban centers, the Hukou, or household registration system, restricts access to public services for migrants in cities where they lack permanent residency. This means that even if a new city has available housing, migrants might be reluctant to move there if it doesn't offer access to schools, healthcare, or social benefits for their families. The Hukou system effectively creates barriers to filling these new cities, diverting potential residents to established hubs where they can secure these rights. Beyond migration, China faces a significant demographic shift that further complicates the picture for its property market. The one-child policy, enforced for decades, has led to a rapidly aging population and a declining birth rate. This means that over time, the natural growth in demand for new housing will likely diminish. The National Bureau of Statistics reported a decline in China's population in 2022, the first in 6 decades. This demographic headwind fundamentally challenges the long-term viability of the current growth model, particularly one reliant on continuous population expansion to fill new homes. While many ghost cities boast impressive residential buildings, the accompanying soft infrastructure often lags. Schools, hospitals, shopping centers, and crucially, job opportunities, are either non-existent or insufficient to attract a critical mass of residents. As analysts from Rhodium Group have pointed out, building homes is only one part of creating a livable city. The social and economic ecosystems must develop concurrently. Without these essential amenities and economic drivers, new cities remain dormitory towns at best and empty shells at worst, unable to sustain a vibrant community. The ambition behind China's urban development is staggering. In many regions, entire cities have been planned and built from scratch within a few years. This scale is driven by the urgent need to urbanize a massive population and boost economic output. However, the sheer volume of construction has created an inventory that far exceeds the organic absorption capacity of the market. Consider that China has built more residential floor space in the last 2 decades than any other country in history, a testament to its construction prowess, but also a factor in its current oversupply challenges. The model of rapid construction and land finance has left many developers highly leveraged. They borrow extensively to acquire land and fund construction, often against the collateral of their existing projects. When sales slow or prices decline, their cash flow dries up, making it difficult to service their debts. This vulnerability was starkly demonstrated by the crisis at Evergrande and other major developers. As reported by numerous financial news outlets, the default risk among Chinese developers became a significant concern, sending shockwaves through the global financial markets. The Evergrande crisis, which erupted in 2021, served as a stark illustration of the risks inherent in China's property market. As one of China's largest developers, Evergrande accumulated over $300 billion in liabilities. Its default on debt obligations highlighted the precarious financial health of many developers, who had relied on aggressive borrowing and rapid expansion. The crisis led to stalled construction projects, protests by homebuyers who had paid for apartments that might never be completed, and a broader loss of confidence in the property sector. The crisis extends beyond developers to individual homebuyers. Many Chinese citizens have invested their life savings, and often their family's wealth, into pre-sold apartments, trusting in the implicit guarantee of completion and rising values. When developers default, these individuals face the devastating prospect of losing their investments, often without ever receiving the property they paid for. This has led to widespread social discontent, including mortgage boycotts and protests, as reported by domestic Chinese media and international news agencies. Chinese banks are heavily exposed to the property sector. They lend to developers for land acquisition and construction, and they provide mortgages to homebuyers. If a significant number of developers default and homebuyers stop paying mortgages, this could trigger a wave of non-performing loans, threatening the stability of the entire financial system. Reports from ratings agencies like Fitch and S&P have repeatedly warned about the systemic risks posed by the property sector's debt to the banking system, especially smaller regional banks with concentrated real estate exposure. The interconnectedness of the property sector with local government finance, the banking system, and household wealth means that a widespread collapse could have profound systemic implications. Unlike isolated incidents, a major contagion from the real estate sector could ripple through the broader economy, affecting everything from employment in construction to consumer spending. Economists at Nomura have drawn parallels to other historic property bubbles, cautioning about the potential for a prolonged slowdown if the situation is not effectively managed by Beijing. Recognizing the risks, the Chinese central government has implemented measures to deleverage the property sector and guide it towards a more sustainable model. Policies like the 3 red lines, introduced in 2020, aim to restrict developers' borrowing based on their debt levels, cash flow, and asset-to-liability ratios. The goal is to curb excessive lending and speculative building. However, these measures have also tightened liquidity, contributing to the financial distress of many developers and slowing down new construction, thereby creating new challenges for economic growth. The government's long-term strategy appears to be shifting away from growth driven by real estate and infrastructure towards a model focused on high-tech manufacturing, innovation, and domestic consumption. This pivot, articulated in various 5-year plans, aims to rebalance the economy. However, transitioning from a property-led growth model to a technology and consumption-driven one is a monumental task, especially when the property sector still accounts for a significant portion of GDP and local government revenue. The ghost cities are a tangible representation of this difficult transition. A critical question now facing Chinese policymakers is what to do with these ghost cities. Repurposing them presents immense challenges. Transforming residential towers into viable commercial spaces, for example, requires significant investment and a fundamental shift in urban planning. Some experimental projects involve converting them into affordable housing for specific populations or even logistics hubs. However, the sheer scale of the vacant inventory makes large-scale, effective repurposing a daunting task, as highlighted by urban planning experts observing these developments. Beyond economic concerns, the ghost cities raise profound questions about environmental and social sustainability. The rapid, often speculative, construction consumed vast amounts of resources and generated significant carbon emissions. From a social perspective, the creation of cities without communities can lead to feelings of alienation and wasted resources. The sustainability of China's development model is now under scrutiny, forcing a re-evaluation of how urban growth should be balanced with ecological impact and genuine human needs. The environmental cost of building so much so quickly is immense. The long-term economic outlook for China is inextricably linked to how it resolves the property crisis and manages its ghost cities. A successful pivot away from real estate reliance could lead to a more balanced and resilient economy. However, a prolonged stagnation or sharp contraction in the property sector could dampen economic growth for years, impacting global supply chains and commodity markets. International financial institutions closely monitor China's handling of this challenge, understanding its potential global ripple effects. The ultimate fate of China's ghost cities remains uncertain. Can they eventually be filled? Some optimists suggest that given China's still large population and ongoing urbanization, these cities may eventually attract residents over the long term, albeit at a slower pace than initially envisioned. However, this depends on the creation of genuine job opportunities, the relaxation of hukou restrictions, and the development of vibrant social infrastructure. Without these fundamental changes, many of these cities risk remaining sparsely populated for decades, monuments to an era of unchecked growth. Policymakers face difficult trade-offs. On one hand, maintaining strict controls on developer debt helps prevent further speculative building and reduces systemic risk. On the other hand, a too tight policy can stifle economic growth, leading to job losses and social instability in the construction sector. Beijing must navigate between cooling an overheated market and preventing a hard landing. Options include targeted financial support for solvent developers, incentivizing migration to smaller cities, and investing in soft infrastructure to make these new areas more attractive. China's construction sector has been a colossal consumer of global commodities, particularly steel, cement, and copper. The slowdown in property development, driven by the ghost city phenomenon and deleveraging efforts, has already led to a significant decrease in demand for these materials. This shift has global repercussions, affecting commodity exporting nations and raw material prices worldwide. As reports from Bloomberg highlight, the ripple effect is felt from Australian iron ore miners to Brazilian copper producers, underscoring the interconnectedness of China's domestic policies with global markets. While economic statistics paint a broad picture, the human cost of the ghost city phenomenon is often overlooked. For millions of Chinese families, their investment in a pre-sold apartment represents a lifetime of savings and dreams. The failure to deliver these homes, or the stagnation of property values, can lead to profound economic hardship and emotional distress. Moreover, the environmental impact of vast, empty developments affects local ecosystems and quality of life for those living nearby. These silent cities carry a heavy burden of unmet expectations and wasted potential. The social implications extend to a growing wealth disparity. Those who invested early and sold at peak prices reaped immense profits, while later investors or those who could only afford homes in less desirable, often empty, new cities face significant losses. This exacerbates social inequality and can fuel resentment. The existence of these ghost cities also raises questions about inefficient resource allocation in a country that still has significant pockets of poverty, highlighting the tension between top-down economic planning and bottom-up societal needs. Internationally, China's ghost cities serve as a cautionary tale about the perils of unchecked growth and misaligned incentives. While some praise China's capacity for rapid infrastructure development, others point to the unsustainable nature of its property-led model. The phenomenon is studied by urban planners, economists, and policymakers worldwide, offering lessons on the balance between state-driven development and market forces, and the importance of genuine demand in urban planning. It provides a unique lens through which to view China's specific brand of state capitalism. Looking ahead, China's future urbanization will likely be very different from the past 2 decades. With a declining and aging population, The era of building entire cities from scratch at breakneck speed seems unsustainable. The focus may shift towards renovating existing urban areas, improving quality of life in smaller cities, and more carefully managing resource allocation. The ghost cities stand as a poignant reminder of a particular stage in China's development, a stage characterized by immense ambition, rapid expansion, and, at times, significant overshooting of actual demand. Ultimately, China's ghost cities are not merely abandoned buildings. They are complex symbols of a powerful economic engine, its inherent contradictions, and the trade-offs made in pursuit of rapid growth. They embody the tension between central planning and market realities, between political incentives and genuine social needs. While they represent massive financial challenges and potential risks, they also reflect an unprecedented scale of ambition that transformed China. The story of these empty cities is still being written, with their future contingent on ongoing policy adjustments, economic rebalancing, and the evolving needs of a nation navigating its next stage of development.